Everybody, welcome back. Welcome to the second little building block that I'm putting together. This one, we're really going to focus on how can we control our risk using the no-nonsense Forex money management rules, because they are different from what you might have heard in the past. And you know, the better we can control our risk, the longer we can stay in the game, right? So before we go any further, disclaimer, I of course did not create any of this methodology. All this content goes kudos back to VP at No Nonsense Forex. And if you happen to stumble upon my site and you have not finished consuming all of VP's content, stop, go there now. You need to learn this stuff the correct way, and that's from VP himself. I will do the best I can to sort of boil things down as I understand them. But you know, to really learn it well, you want to make sure you've already consumed all of the content from VP's website. Okay, so last time we talked about three main sides to being a successful trader. You know, first of all, you need to be consistent. And this is probably the hardest part of the whole thing, honestly. You need to have the discipline, you need to be patient, and you need to persevere during those rough times. And those rough times are going to come. There are going to be times when you are losing, and you're like, what the heck am I doing? So take a breath, maintain that positive mindset, and just keep on trekking, you know. The next thing is make sure you have a good strategy to follow. And this is where a lot of people focus all their time, you know. It's finding those indicators, putting them together, finding that magical combination that is going to be profitable. But once you've done that and you have back tested it so that you have the confidence in that system, write it down. Make sure that it is a tested trade plan. And in that plan, it gives you very specific go or no go rules. The whole point of No Nonsense Forex is to take judgment and subjectivity out of the equation. Make it as automatic as possible. What we're going to focus on in this little module is this third one. It's how do we control risk? Because if you don't control your risk, you could blow up an account very easily. So No Nonsense Forex has some specific money management rules that you need to understand so that you can be successful in this area, and that's going to lead you to being a very successful trader. So what is risk? Well, risk is the amount of money that we could lose in any trade. You know, every time we make a trade, we are opening ourselves up to a loss. I mean, that's simple. Well, how big of a loss do you want to lose? Overall, your risk is really kind of boils down to two things. It's the amount that you're trading, which is your lot size, times your pips or your distance away from your entry. So this is talking about a distance not in your favor. Now, there's a little asterisk here because to really get a true dollar for dollar risk amount, you also need to consider the base currency and what currency you are using. And that's a whole nother conversation. We're not going to even go there right now, but we're basically going to talk about risk in thinking about it as our lot size and our pips, meaning our distance from entry. So how do we control risk? Well, I don't know if you're like me, you've always been taught control risk with a stop loss. And that's what we continue to do. So let me start off with an example that is not no-nonsense Forex. I'll just say that. This is the way I learned to trade before finding VP. So here we are. Here's our risk equals our amount times our pips. Well, typically, people have taught me in the past that you're looking for changes in direction. You are wanting to find a new trend. So in this case, we'd be looking for a buy, and we say, okay, we want to buy. Where are we going to put our stop loss? So a lot of times they'll tell us, oh, put it just below the last swing high or swing low. Well, that is very subjective. So this distance in pips can definitely change and be fluid, but it's not fluid in any kind of calculated sense. It's fluid in a very subjective sense. And I was always taught to use the same lot size. For instance, I could use a 1 standard lot size, or I could use a half a standard lot size, which is 0.5, or I could even use a mini lot size, which is 0.1. All of those are choices, and we have choices, but typically the old way, we always just learn, okay, pick a lot size, you stick with that lot size, and then pick your stop loss. Oh, and by the way, depending on the stop loss, determine your take profit based on like 3-to-1 or 4-to-1 ratio. As you can see, it's probably not the best strategy. You have a very static amount that you're using, and your distance is subjective. So how do we get around that? Well, the no-nonsense Forex instructs us to use a specific indicator to help control our risk, and that's called the average true range. And if you've gone through VP's material, hopefully you are well aware of the ATR. The ATR is basically giving us the average movement of price over a certain number of days. And VP suggests a period of 14 days. Well, how does this help us? What does that do? Well, in this scenario, okay, if we still want to enter on this candle, rather than saying, okay, I'm going to subjectively pick a stop loss down here, I am now going to use the ATR to determine my stop loss. Okay, so depending on that average movement of price, okay, we can, over the last 14 days, we can almost predict how far that next candle will move. So that helps us, because at that point, we will then set our stop loss to be 1.5 times that amount, rather than just an arbitrary subjective number. The other thing that no-nonsense Forex does that's different is you're also you're fluid with your amount that you trade. You don't trade a static lot size. Your amount is a calculation based on your account balance. So if you start off with $10,000 in your account, well, 2% of that is roughly $200 if you're trading USD. But if you go up to $20,000 account, then you've got some more flexibility, and 2% of your account is now approximately $400. So that amount is not going to be a static number, but it is going to be based on what your current balance is on your account. What happens is we put these together, and now we've got a very dynamic system based on our account balance and the average movement of price rather than anything subjective. So here are the rules, okay? The entry rules, the no-nonsense Forex money management rules. You're going to always enter 2 trades. Now, a caveat to this is sometimes you can enter 1 trade with the full 2% risk, but then scale out 50% when it hits your 1 ATR. Just saying that up front, but to make it simpler, let me explain it by actually entering 2 trades. So the first trade, again, we are going to have half of that 2%. So our lot size will be 1% of our account balance. Our stop loss will be 1.5 times the ATR. Remember that average true range is going to give us a number, so we're going to use 1.5 times that number for that candle, and our take profit will be 1 times the ATR. Our second trade is also going to be 1% of our account balance. It's going to have the same stop loss, 1.5 ATR, but for the second trade, we're not going to put in a take profit amount. We are going to let this one run, so to speak. And this trade will run until we are told to get out. So if it makes it up past that first take profit, then we will move our stop loss to break even and just let the trade run. We will then be looking for signals to get out, either an exit indicator or a flip of our C1 or our C2 indicator, or something that's going to tell us to get out. So this is what it might look like. The same situation, only using the no-nonsense Forex methodology. Okay, so we're at this candle. Now we don't know, I don't have any indicators on here, but we're assuming that we have a signal to go long. Okay, so we're at the same place. So now, rather than arbitrarily trying to pick and choose a spot to put our stop loss, we place our stop loss exactly 1.5 ATR below, okay, where we go in, and we set our take profit for our first trade to 1 times ATR. And then we hope that our trade will move up. That first take profit will be hit, the first trade will be closed, and the second trade will run. And at that point, of course, we're going to move our break even up to that, after that first take profit. Let's look at how this works on a real chart. So this should look familiar if you've been following my forward tests. This is my typical setup where I have all the pieces of my algorithm here. But what we want to do is we want to be able to now determine for a trade what is going to be our stop loss and what is going to be our take profit. Now, you can add the ATR indicator to this, and you can just use that number and you can manually calculate 1.5 times for your stop loss and 1 times for your take profit. Or you can do what I do. I use the no-nonsense Forex ATR. It is an indicator. Notice these numbers down here. So it is automatic. As you hover over a different candle, it is going to give you what the stop loss is, already figured out, and what the take profit is. So let's look at an example. So here's our system. Here we have a new signal on our SSL. Okay, so we've got confirmation, it is an uptrend, and we have enough volume, and it's above the baseline. So if we were to enter on this one, if I click this indicator, the no nonsense Forex ATR, will automatically put those numbers up on the chart for us. I'll tell you, this is like the best thing since sliced bread. It's very handy. So now I can see that this is where my stop loss would have been. This is where my first take profit was. So this particular trade was a winner. Okay, and it actually turned out to be pretty good. So if we went in here, we went up, we would have gotten out right here because this is my exit, my QQE cross. So right there on the close of this candle, we would have gotten out. So that would have been a pretty nice run. So if we pull that down, let's see. Oh, yeah, like 626 pips, not bad. So that's how it works. And if you can either then use a specific no-nonsense Forex trade manager or trading assistant to place your trades, or you can just open up a new trade and put in those numbers right there yourself. So however you decide to do it, good little tool, keep in your back pocket. And again, I have all these indicators and things in my toolkit on the website if you want to find a place to download them. In the meantime, I hope this is helpful. Again, this is the No Nonsense Forex Money Management Entry Rules, so we don't blow our account. Take care.